Because we've been retirement planners for some time now, we've started helping people in their 50s and 60s, and then before you know it, they are 70 and a half or 72 when they're required to take out their required minimum distribution, which is just money from your IRAs or 401ks that the government says we have to start taking out and paying tax on. And what they're finding is that sometimes they don't even need that money for income, but they're having to pay tax on it anyways.
And even if you're not 70 and a half or 72, this is actually a good time. Maybe you're in your 50s or 60s to start planning ahead and doing some retirement income planning to see what will that pay raise look like when I hit age 72.
And if you're a client, you may have heard us say that you can control two things when it comes to investment planning. It's the cost and the taxes. So in this video, we're going to talk mainly about the taxes piece of it. If we haven't met you yet, I'm Dave Zoller, and this is Tim Meisenheimer, and we run Streamline Financial, a retirement planning firm with Luke and Sean and our team. And we've been helping people for 10 to 15 years. So again, like we said, a lot of them started mapping out their required minimum distributions well before they got to the age 70 and a half or 72. And it's really helped them lower the amount of tax they pay over their lifetime. If you can think about it ahead of time, it really pays off. So we want to talk about two ways to think about your future RMDs, and actually two ways to potentially lower them.
So the first way that you can plan ahead for your required minimum distributions is what's called the qualified charitable distribution. We're going to call it QCD from here on out to make this video a little shorter. So with the QCD, when you reach 72, you're starting to take your required minimum distribution, and the QCD rules say you can actually take from your IRA and give directly to charity without it counting against your income for tax purposes, but while meeting the RMD, required minimum distribution requirement. So it could look like this. You've got your IRA, and at age 72, you have to take your RMD. So sending money straight to you. And then from there, you're gonna pay taxes on the distribution that you take out of your IRA. That's why the RMD was created. Then from that cash, you will send money to charity, and you will get a deduction if you itemize your deductions. So that's scenario one. Scenario number two says, well, I have to meet my RMD, but I don't need it necessarily. I'm used to giving, and so I give my QCD directly to the charity. In this case, there are no taxes on that gift. You're going to be really careful with this. You cannot give a QCD to a donor advised fund if you're used to using that as a vehicle for giving. And then from there, this is what's called an above the line tax deduction. So in both cases, you get a deduction, and this is where careful tax planning is really important, because one of these two scenarios may be more beneficial for you. Which one? Hard to know without doing any forward-looking tax planning. This is one of the things we look at on an annual basis for our clients. Now, a couple years ago, when they updated the tax laws to move the RMD back to age 72 from 70 and a half, one of the things they didn't change is you can actually start doing the qualified charitable distribution at age 70 and a half. So something to keep in mind there. There's an 18-month window where you could start taking advantage of this a little bit earlier than maybe you thought. One of the other strategies that we take a look at when looking ahead at RMDs in the future at age 72 is before age 72, taking some years to convert your IRA monies to Roth IRA over that time period. And the reason you would want to look at this is you're doing some future retirement income planning. Say you're 60 years old, maybe you're 50 years old, and you see at age 72, a big bulk of your nest egg is in IRA or 401k plans. That could be an unwanted or unneeded pay raise at age 72. And we've even seen people jumping up tax brackets because of that. Maybe your income is already covered from Social Security, pension, and other investments along the way, and the IRA would just be extra, increasing your tax liability. So one of the things to think about is, could you convert some of that IRA money or even use it in your 60s so that when age 72 comes along, the balance in your IRA is lower. that's going to lower your tax burden come age 72. And when we plan for this, we look ahead to see what's the tax bracket going to look like when that pay raise comes. Another thing to think about too is maybe you're in your 50s. This is a great time to be building up a taxable bucket, like a brokerage account, so that when you hit, say you retire at age 60, you can start using that taxable bucket to A, live off of in a really low tax bracket potentially, and then B, use that to pay for the Roth conversions along the way, converting your IRA to Roth IRA money. Again, Roth IRAs do not have required distributions later on in life.
So as you might gather, there's a lot of moving parts here when it comes to strategy around this tax planning and required minimum distributions. But hopefully this gave you kind of a high level understanding of two possible ways, two things to think about as you're creating your own retirement plan, or as you're going to meet with your advisor, and things to bring up if they're not bringing it up. And by the way, if your advisor is mainly focused on investment planning and different mutual funds or ETFs or whatever you might be doing there, that's important, that's good. But if you're starting to realize that there's other important parts to your retirement plan, like this tax planning, or like the withdrawal strategy, when to take from what accounts and why, feel free to reach out to us, because that's really what retirement specialists do. Those are the things. There's really, you've probably heard about the 5 different parts of your plan. The 3 that we focus on in the first meeting is the income plan, and yes, the investment plan, and also the tax plan. So if that's of interest, go to our website, streamlineplanning.com, and click on Get Started, and then see if we've got a space available. If we do, we'd be glad to talk with you. If we don't talk with you, then hopefully we'll see you in the next video. Take care.
Bye-bye.